Welcome back to Beyond the Benchmark. I'm Ryan Kasper. Economic data from the U.S. government remained on hold this week as the shutdown stretched into its fourth week. That means we're still missing key reports, from third quarter GDP and personal spending to PCE inflation, durable goods, and jobless claims. But the one headline event that did move forward was the Federal Reserve's October meeting. And as expected, the Fed cut interest rates by 0.25%. While the move was widely anticipated, the tone was far from unanimous. Chair Powell acknowledged that the balance of risks has shifted, with more concern about labor market weakness. But he also emphasized that a December cut is far from certain. That hawkish lean caused a bit of market whiplash midweek. The Fed also confirmed it will begin reinvesting maturing mortgage-backed securities into Treasury bills only, continuing its slow retreat from the mortgage market and shortening the duration of its balance sheet. So the Fed is easing policy, but still signaling caution. The challenge is that markets have priced in a faster pivot, and Powell isn't ready to confirm that yet. Turning to the data we did get, housing continues to show some cooling. The S&P CoreLogic Case-Shiller Home Price Index was basically flat in August, up just 0.2% after adjustment. Price gains have shifted from the Sun Belt back to northern cities like New York, Chicago, and Boston, while pandemic boomtowns like Tampa, Miami, and Phoenix are now seeing mild declines. The broader FHFA Home Price Index told a similar story. National prices up about 2% year over year, half the pace of last year. In short, housing isn't falling apart, but the era of easy appreciation is clearly over. Consumer confidence remains fragile. The Conference Board's index slipped slightly in October, with Americans reporting more pessimism about future job availability and business conditions. Interestingly, mentions of tariffs fell a bit, but inflation remains the top concern, and expectations for prices next year ticked up to nearly 6%, about twice the current inflation rate. Markets took all of this in stride. U.S. large caps rose modestly, while small caps pulled back as yields climbed. The S&P 500 gained about 0.75% for the week, led by strength in technology, where Nvidia crossed the $5 trillion market cap mark, and consumer discretionary names like Amazon and Tesla. Defensive sectors and real estate lagged as interest rates crept higher. Earnings season remains strong. With roughly two-thirds of S&P companies now reported, 83% have beaten earnings expectations. The blended growth rate for Q3 sits near 11%, led by tech, utilities, and financials. Globally, markets were mixed. Japan and emerging markets outperformed, while Europe and the UK slipped on currency headwinds. Bonds declined on the back of higher yields and a stronger dollar, and commodities were mostly flat, with oil prices holding near $61 a barrel. The big takeaway this week: the Fed delivered what markets expected, but with a message they didn't love. Policy is easing, but not on autopilot. Meanwhile, growth remains steady, inflation still sticky, and the data blackout from Washington leaves investors flying half blind heading into year-end. I'm Ryan Kasper. Thanks for tuning in to Beyond the Benchmark. Stay disciplined, stay informed, and we'll catch you next week.